How's it going, everybody? It's your boy homie G, and I'm back. All right, my little homies, today I got a great financial lesson for you. It's all about stocks. Now, I can't promise to give you everything there is to know about stocks in this one video. No one can. It'll take like an hour or more, but I'm going to try to do my best. So let's start out with stocks. Why do they exist? Where do they come about? So sometime in the 1600s, Europeans, I don't know if it was the Dutch or the British, they came up with a clever idea for raising money. Okay, these individuals got together. They say, hey, we got a boat. We need to go trade with the Indies, subcontinent of India or around Africa for whatever, spices, whatever they needed, right? And they didn't have the money to finance their voyages. So they decided to come up with a brand new financial invention called a stock. Now these companies said to investors, hey, we're going to go to the Indies or whatever. We're going to go get some spices. We're going to trade our stuff for their stuff. We're going to make a lot of money, except we only have enough to get to the destination. We don't have enough to feed all the crew in the boat. We don't have enough to get back. We just have enough to get there and start our trading. So is there anyone here that would like to invest in our company? We promise to give you a share of all of our profits commensurate with however much money you put in. By the way, just so you don't feel like we're scamming you, we're gonna give you these certificates called stocks, and you're gonna get to take them home, and it'll have our nice seal of approval, our stamp and our signature, and it'll say how many shares you own of our company, how much of an investment you've made in our company, and whatever we get back in terms of profits, we're going to give you a commensurate amount. So if you own like 10% of our company, we're going to give you back 10% of our profits. And all the rich Europeans were like, well, that's great. I could just sit back here, wait for these guys. Hopefully they don't get killed by the natives or whatever. And when they come back, I'm going to make some money because they're going to pay me back 10% on whatever I invested. Okay, so that's how basically how stocks originated. It all had to do with raising money to finance the growth of a company. Now that's still how it happens today, to this day. Companies issue stock, I should say, at the very beginning when they're starting out to become public. In an effort to grow their company, they issue stocks, and investors who might like the company, who have heard of the company, throw in some money, buy the stock, and now the company has a bunch more money to invest in equipment, materials, to buy assets, whatever. Okay, so that's why stocks exist. They're just a European invention that's still in use today by companies. Main point, they're trying to raise money to do things, to grow. Okay, so we know now they're investments. Investors invest in companies buying their stock because they expect a return on their money. You don't invest unless you expect a return. But at the same time, you gotta weigh your risks, my little homies. How much can you make? How much can you lose? Well, you gotta know all about the company, all about their business, what it is they're doing, understanding all the risks that come with that particular company. And in general, these days, all the risks associated with the world, right? Because now things have changed. They're no longer like the 1600s. So companies now are affected more by more things that just come up out of the blue, like a pandemic. That affected every company worldwide, okay? Surely there were pandemics in the 1600s, the Black Plague, whatever. So investors had to account for a company losing money or losing profit because their workers are coming down with the plague. Now it's kind of the same, right? I mean, coming down with COVID-19, companies not going to be able to put their workers to work, make money, etc., etc. So that's just one type of risks. Now I can go into what they call that type of risk, but that's for another video. But you have to understand what you're getting into as an investor because stocks are investments. Now, stocks, they're also called equities. Equities, key word. Why equities? Well, this whole idea of equities revolves around ownership in the company. So technically people say, well, as a stockholder, you're part owner of a company. You own so much of the company. Now, is this true? Well, technically, yes. Legally, no. And I'll show you why, okay? This is a big misconception. People don't really understand this whole concept of ownership, okay? They misconstrue it. So let's see how. Hopefully this doesn't break on me in the middle of the video. Oh, it sure did. Let me get this back up. Sorry, my little homies. Okay, I had this whole setup and it didn't work, but here we go. Okay, so stock equity, what's all this about? Well, let's say there's a company called Homie G Enterprises. That's my company. Now, I decide to raise money because I want to grow my company. What do I make? I don't know. Maybe it's a service instead of a product. Maybe I do something for some people that need a particular service. Or maybe I sell a certain product. Whatever it is. Now I say to the public, hey, I'm going to issue 1,000 shares of Homie G stock. Okay, HGE is my ticker symbol, HGE. 1,000 shares. And I say to the public, I'm going to price my shares at $10 each today at this time. Now, is this how it works in the regular stock market? Not at all. Surely, stocks open up at a certain price in the morning. But by the end of the day, they're not going to be at that price because in a market, people exchange their shares, they buy shares, they sell shares, and the price goes up and down all the time. In nanoseconds, my little homies, computers. Okay, but let's say for this example, because we're keeping it simple, $10 per share of my company today. Now, I'm an insider. I am the CEO, Homie G. Sister G, my wife, is also part of my insider team. She's management. And then CEO is maybe my daughter. And my son, he's too small. Maybe I don't get him involved in the company. But maybe I do. Who knows? Whatever. I could keep going, right? It says etc. So we're all the insiders. We own 50% of the company because it's our company. Let's say I tell the public, I'm going to issue 1,000 shares, and this represents 50% of Homie G's company. That's available equity. That can be owned by the public. Okay? So now, let's say an investor comes in. Hey, Homie G, I like your business, man. Yeah, you got a great business. I know you're gonna make a lot of money selling this product, whatever. I'm gonna invest in your company. As a matter of fact, I like your company so much. I want all these shares, all these 1,000 shares you made available. So that would represent $10,000 of an investment on the part of that investor. Why? 1,000 shares, each are $10. 1,000 times 10, $10,000 worth. Okay? Now this one investor owns 50% of my company. Now this is a very simple example. Okay? 50% means they like co-owners now. I wouldn't necessarily want that. I wouldn't want them to start telling me what to do with my company because they can, because they own half of it. They're not a majority owner, neither am I though. So technically, this is not a good setup for me. But this is not how it really works in the overall stock market. In the overall stock market, there are so many people investing in a particular stock. It could be Disney, or it could be Wells Fargo, or it could be Delta, or it could be Netflix, Amazon, whatever. That their ownership stake of the available shares is super, super, super tiny. Let me keep going and show you how. Let's say scenario B. Two investors now decide, hey, we like Homie G's company. Each buys an equal stake, equal number of shares. Okay, there's 1,000 available from my company. That would be 500 and 500. That's a $5,000 investment by each investor. Now each investor owns 25% of my company. The other one owns 25%, and my insider team still owns 50%. Okay, you getting this? Now, scenario C. What if 10 investors decide, oh man, we all want at it. We all want 100 shares. That's 10%. 100 over the 1,000 shares available is total 10% ownership stake in my company. But is it really 10%? No, because I still own 50%. So that's really 100 shares that each buys out of 2,000 shares, that's 5%. So they technically only own 5%. So when you buy a stock in the stock market, your position is not only made tiny by the millions of investors that are buying stock, but also by the maybe 10s, 20, however big the company is, of insiders that also own stock. Okay, so you don't technically own as much as you think you own. Okay, especially because we're dealing with millions of people investing in a company. Okay, now let me show you what that looks like. Get out of here. Okay, so it's like an ever-changing pie. Okay, this blue piece might represent Warren Buffett's position in a company because he has millions of dollars to work with. He could literally spend, millions of dollars and buy 10% of a company, or maybe more. He could buy the entire company outright. He's got billions of dollars. Well, this whole entire pie would be Warren Buffett's now. He'd own the company, and he's done that many times. So every single morning in the stock market, it's like somebody putting out a pie. It's freshly baked, it's brand new. And as soon as the market opens, people start buying and selling. So these slices get resliced and recut, and people now own this much, and now they own that much, and now they sold this much. And it keeps changing every split second. This might be the pie for what company? Amazon or whatever. And it's changing every second because people are buying and selling their shares. Okay? So now let's go back to that question. Do you really own part of a publicly traded company when you buy stock? That's what everybody will tell you on the videos that you see on YouTube. Oh, this is what a stock is. You own this percent. You have equity. You own so much of the company. Not really. You see, what if a company goes bankrupt, like JCPenney did, or like all these other retailers that are going bankrupt? Guess what? There were stockholders in that company. How much money are they going to get back now if they kept the stock, if they didn't get out, if they didn't sell their stock before the company went bankrupt? Nothing. They're not going to get back nothing. Okay? Why? Well, first in line to get any money back are the bondholders. Bondholders. Bonds are a different thing. Okay? They're people who invest in bonds basically allow a company to borrow their money for a specific rate of return on that money. Okay? So they're the first in line to get back, because JCPenney is going to start selling all their items that are left. They're going to have closeout sales, right? And whatever money they get from their clothes or from whatever they have left in their bankruptcy sales, because they're going out of business, the bondholders are going to divvy that up first. Then come the preferred stockholders. Who are preferred stockholders? They're people on another level. Okay, they're getting different prices on the stocks than you are. Okay, you might not know who these people are. And then finally come the common stockholders. That would be us little guys. Okay, buying and selling stocks on the market. So by the time you get down to here, there's nothing left of that pie. Okay, because everything is gone. These guys get the money first. We don't get anything. So technically, are you a part owner of a company when you invest in the stocks and the stock market? Yes and no. Really no though, because if the company goes bankrupt, common stockholders get nothing. Okay, now I've shared a lot with you today, my little homies, on stocks. This is just the tip of the iceberg. Okay, I got a lot of this information today from my book. Okay, I wrote this book for all the little homies so they learn the entirety of stock market investing. I teach you in this book how to protect your money. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Who said that? Warren Buffett. Okay, but I teach you how to preserve your capital and how to make money in stocks as well. So you can get this at Amazon. Or you could just hit my link on my YouTube channel and it'll direct you to the page at Amazon. All right, there's a lot to learn. Definitely learn this, my little homies, because you can make money in stocks. I can probably do another video on how price works and how stocks get priced, and then how people make money and lose money in stocks. I might do that, I don't know, but surely that book will teach you a lot more than what I can teach you in a video. All right, my little homies, it's been great. This is the longest video I've ever made, but I hope you've watched it and you keep watching it so you get the gist of it, okay? All right, I'm out. Peace.